We've just hit a turning point in the UK housing market. For the first time in years, it feels like momentum has shifted. Sellers are starting to panic, price cuts are becoming normal, and buyers are finally getting their power back. We've had years of undersupply, bidding wars, sealed bids, and over offers. But now, stock is rising, demand is cooling, and the deals are falling through at the highest rate since the pandemic. So in this video, I want to break down what's really going on, what's triggered this sudden shift, why the fundamentals are finally starting to crack, which regions are feeling it first, what's likely to happen over the next 12 to 24 months, and what this all means for us. Let's get into it. Now, we all know what caused the boom. Between 2020 and 2022, the Bank of England cut the base rate to 0.1%, the lowest in history. The mortgage rates dropped between 1 and 2%, and combine that with the stamp duty holiday, demand exploded. According to the ONS, average UK house prices rose £50,000 in just 2 years. That's about a 25% jump. And in some hotspots like the southwest, Wales, and parts of the northwest, prices were up even higher, between 30 to 35%. Everyone piled in, first-time buyers, investors, developers, and upgraders. But from late 2022, things started to catch up. The Bank of England began hiking rates at the fastest pace in decades. The base rate is now 4%, and an average mortgage rate has gone from 1.5% to 4.5%. That increase has blown affordability apart. To put things into perspective, back in 2021, the average UK house price cost around £270,000. Now, with a 10% deposit and a 2% mortgage, monthly repayments were around £1,000 a month. Today, the average UK house price is around £288,000, but at a 4.5% interest rate, the same mortgage now costs £1,600 a month. That's a 55% jump in mortgage repayments, with wages nowhere near keeping pace. So demand has fallen off a cliff. Mortgage approvals are down 27%, first-time buyers are down 25%, and cash buyers now make up 40% of all purchases within the market. This affordability crunch has been the single biggest drag on the market, and it's why the market is beginning to flip. While demand has collapsed, supply is quietly climbing again, with Rightmove data stating that the number of homes for sale is up 28%, and the average time to now find a buyer has stretched from 21 days to 55 days. And in comparison to 2022, there are 60% more listings available. This is further supported with the Zoopla data stating that there's the highest level of stock available since 2018. This has been driven by three key things: remortgage and affordability pressures, with around 1.5 million households are coming off the sub 2% fixes and are now jumping onto the 4 to 5% rates. Landlords exiting, buy-to-let profitability has been hammered by mortgage costs, Section 24, tax changes, new EPC rules, and over 40,000 landlords sold up in the last 12 months, flooding the market. Life events, people still move for divorce, jobs, or growing families, and many don't want to wait out for a falling market. All of a sudden, we've got more stock, fewer buyers, and longer selling times. That's the definition of a market flip. Now, here's where it gets serious. People always say, property never crashes. And to be fair, it's been true for decades. Since the early 1990s, the market has been almost relentlessly buoyant. In 1990, the average house price cost £58,000. Today, it's £288,000. That's a 396% increase. Even adjusted for inflation, prices have more than doubled, because the UK simply hasn't built enough homes for a growing population. The existing stock kept getting more valuable, but for the first time in decades, that dynamic is under threat. Rightmove states that prices fell 1.2% in July. That's around £5,000 wiped off the average property value in a single month, and London was down 1.5%. They also said it's the sharpest summer fall in 20 years. And when you zoom out, there are four big structural factors that could trigger a far sharper correction. Number one, the economy is stagnating. GDP has stalled, the economy shrank last month and will likely shrink this quarter too. And after the hike in employers' national insurance, over 200,000 jobs have been lost since the budget. Retail sales are weak, factories are shutting due to sky-high energy prices, hospitality is struggling under business rates, a stagnant, falling economy means fewer people have the confidence or the income to buy. Number 2, landlords and second home owners are exiting the market. The government has made it clear it doesn't want people owning multiple homes. Section 24 tax changes, EPCs tightening, renters reform bill increasing tenants' rights, and local councils doubling or tripling council tax on second homes, adding £10,000 a year in additional costs. There are 4.4 million private rented homes and 700,000 second homes in the UK. If even a fraction of those get sold off, it would flood the market with supply and hit prices hard. Number 3, taxes and green levies are rising relentlessly. Councils can raise council tax 5% a year, and most are doing it. Stamp duty is fully back, energy bills are staying high, water metering is coming in. All of this raises the cost of home ownership. People might have traded up, simply won't be able to afford it, which chokes off demand. And number 4, a looming fiscal crisis. UK government borrowing is running at over 5% of GDP, and gilt yields are now above France, Germany, and even Greece. Markets are nervous. If they lose confidence, the Bank of England could be forced to raise rates further to support the pound. If that happens, it could be the trigger for a full-scale collapse in house prices. This video is sponsored by Landstack. When there are market difficulties, this also brings many opportunities. Landstack is the ultimate sourcing and mapping software for property developers and land sources looking for off-market opportunities. I use Landstack daily to track property sales data, planning history, and find land opportunities before they hit the market. Now, if you're serious about making the most of the next big buying opportunity, check out Landstack today and start sourcing smarter. So this isn't just theory, it's starting to show in the data. Nationwide states that house prices are down 2.2%, with the Zoopla stating they're down 4% from their peak of 2022. But with inflation rising, real prices are starting to fall. Regionally, London and the South East were most highly impacted, with a 6 to 8% fall from peak. East of England and the South West down 4 to 5%, and the Midlands and the North are flat to slightly positive, but fading fast. Rightmove reports 1 in 3 sellers cutting asking prices by £20,000 to get a sale, with 50% of all sales collapsing entirely. That's the highest since 2020. So where does this leave us? The UK housing market hasn't crashed, but it has flipped. We've gone from a seller's market to a buyer's market. Affordability is struggling, stock is rising, demand is weak, and underlying economic cracks are starting to show. This isn't 2008, but it could be something similar if confidence starts to break. Now, if you're buying, negotiate hard and build in a buffer. If you're selling, price realistically or sit on the market. And if you're investing, don't rely on capital appreciation. Focus on buying right, getting cash flow, or longer term developments. Because while most people sit on their hands, the ones who act decisively and with intelligence will be the ones who benefit when the market rebounds. As Warren Buffett once said, be fearful when others are greedy and greedy when others are fearful. So that's the reality of the UK housing market right now. If you found this video useful, hit like, subscribe, and drop a comment telling me what you're seeing locally. Are people panicking where you are? Thanks for watching, and I'll see you in the next one.